I think personally, silver is the screaming buy of the moment. And I mentioned to you just pre our discussion, the lease rates on silver for the institutional buyers. These are the guys that buy the 1,000-ounce bars. I'm fortunate enough to have a few, but they're pretty rough. And they're essentially malted down and they're used in phones, etc., etc. So whilst there might be no premiums being collected on the small fare, that is the everyday retail buyer, there's the lease rates have reached, and I'm going to take you to a separate chart on this. This is why I really think silver is a bit of a now. I'm starting, a lot of shoes are dropping. I feel it's a bit of a screaming buy.
Francis Hunt is the founder of the Market Sniper and originator of the Hunt Volatility Funnel method, a trading methodology that focuses on identifying key breakout trading opportunities and key trading levels for various assets, including precious metals. As a renowned technical analyst and trader primarily focused on the precious metal space, Hunt, like every other investor in the space, says he is very interested in the screaming buying opportunity silver presents at the moment. On January 12th, buoyed by expectations of better inflation data from the Bureau of Labor Statistics, silver prices roared $23 for the first time since hitting $24 on January 1st. However, instead of reduced inflation that would have cemented expectations of rate cuts later in the year, CPI, Consumer Price Index, increased by 0.3% in December, following a 0.1% rise in November. Core inflation, excluding food and energy items, was expected to rise 3.8% year-over-year in December, following a 4% increase in November. However, core prices rose 0.3% month-over-month in December at the same rate as November's increase, making the year-over-year increase total 3.9%. The latest CPI data raises the question of how the Federal Reserve will redirect its policies moving forward. As a result of the gloomy inflation data, silver prices have declined, and the precious metal is now trading at $22.64 per ounce. Despite the plunge in silver prices, Hunt sees this as a great buying opportunity as he expects silver prices to soar rapidly over the next few months. We will now bring you clips from Hunt's recent interview with Liberty and Finance. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. Thanks, and enjoy the video. The first part of this video features Hunt's outlook on gold.
The gold, the metal, has got exceedingly comfortable with building a base above the 2,000 mark now. So as I mentioned, the ground is conceded in stages, and because it's slow, it's almost like you're watching a continuous video. You don't see the changes. What you need to do is look away and then look back, and then you can see snapshot to snapshot that in fact we progressed immensely. So we've gone from the better part of 3 years after the 2021 high of not getting a single monthly close above 2,000 to now not only breaking it in November, but apart from a very short spell on the slap back here, permanently staying above the 2K, which is one of the ways that price behavior establishes what I would call a base camp at a new staging point before winding up to take new territory on the upside. So once you've taken a key level, you consolidate around that level. And one of the price behavior aspects that show consolidation is that compression of volatility. So you'll note I've drawn from the low to the absolute low of high. There's a kind of steepness to those two lines that is showing some degree of flattening in these two lines, and right now may flatten some more. And this all points to a nice volatility constriction. And typically the on balance of probability assumption in these cases is continuation. And unlike something like a head and shoulder that shows exhaustive elements to it, this actually shows consolidation, comfort with the level, calming, and that is typically a setup for further upside. And I would argue that spike, the extent of the slapback and the amplitude it creates from around the 2,150 to the 1975, that is an amplitude of projection to the upside for us. So actually, as negative as being slapped back is, it sets up a new amplitude for us for upside moves. So we'll be looking for the next a $200 type move in all of that, because you made it to just about 2,150 plus plus 25, about $175 projection from around 2045. We're working on that being the line of settlement. You can see there's sort of a line through there where we are a little bit above, a little bit below. So it's almost like a sine wave. Where is the zero line that you're a couple of pips above, a couple of pips below? Where's it centering around? And that's kind of the place where it's happy to consolidate. And that looks to me to be around 2045. And when you add 175 on that, you're going to see us going past the 2,200s on our next projection up move. And this is all we're on a lower time frame. I often start on the much bigger time frames, but I've been on a few times before. I don't want to rehash everything that hasn't changed that much. But this is all part and parcel of staircasing, and there will be rests and there will be pullbacks. That journey to the 293,000 gateway as the next key resting point. So I think it's looking exceedingly good for gold in the dollar and across all currencies actually to make new headway. I'll let you unpack that before I go on.
So what is the time frame on your projection for $2,300 gold?
Yes, that's a very good question, and it does point nearish term. Most of especially when we're talking silver, we tend to push the timeline out a little bit. But it's difficult for me to tell you the future. I can't, but I can hazard a guess. Typical proportionality would be something like that. And then, calming, and it can extend. And thereafter, once you come for that third high, you actually start to accelerate, and then you get the breakout. So a little bit of a pullback can be in the mix. I would suggest that's one of the best entry points on a down leg. So below 2045 to 2030 would be an absolute accumulation box with this current technical structure that I have in mind, which is a probability, not an absolute, if people can please bear that in mind. But I would say an accumulation during here. And the way I've drawn the pink line, you might not have a long period in that box. And then the breakout, the way I've drawn it, this could be happening still this month or into February.
Gold price is expected to face a little bit of pressure in the coming days as a reaction to December's retail sales data from the US Census Bureau. On Wednesday, the Bureau reported that sales tickets at retail stores were significantly higher by 0.6% in December, against expectations of 0.4% and a previous reading of 0.3%. Retail sales, excluding automobiles, rose by 0.4% against expectations and the prior reading of 0.2%. The data has significantly reduced the chances of interest rate cuts by the Fed in March. Fed policymakers have been favoring interest rates to remain higher for longer, dashing market expectations of several rate cuts in 2024. The pressure on prices is expected to ease out going into the weekend, and traders and advisors re-strategize in preparation for what lies ahead. Whatever step the Fed takes, the impact on price will be short-lived. This is why Hunt is still very bullish on gold and silver prices. Let's get back to the interview.
When people need industrial silver, so this is not the bullion purchaser that is buying the 10 ounces and the 1 ounce of silvers and the tubes and the monster boxes. This is the industrial buyers that are buying the 1,000-ounce bars en masse and taking delivery in contracts. The lease rates have got very, very high. And the last time, here I'm doing it in pink over the orange, the last time that happened was in and around silver $10, and you did a run up to a 49 at that period. These are localized highs, and even these periods had small runs. You can see them here just pre the COVID event, and they're up there, but they are small beer. The only one, this rate here where we passed 3%, it's getting to the levels of the move, the extremities of the previous move. And that was the fulcrum of a major bull move. You've got about 4.5 times on your money there. And I would argue we're well overdue. This was a truncated bull. It didn't do the fullness of its move. We kind of jumped into QE. We got into a lot of suppression on metals, and they kind of stopped the clock on the gold and silver run. And you didn't get that 1980s fullness that I still think we're well overdue. And it's taken, with the can has been kicked that long down from 2011, and now we're at the same place. But their ability to contain this to the same degree, with the desire of solar panels and so many other things. So things like solar panel makers will buy 1,000-ounce bars, rough cut, crude, 32 kilograms worth of, pure metal. And that's the cheapest it comes way to get big ounces. And that's what's going into the likes of solar panels. And around here where I am at, everybody's in fear of grid down, a loss of energy and power, and is grabbing solar. So much so that it's almost a theft item. You have to make sure it's secured correctly. And I think that's coming for the world over. The confidence in the ability of statism to provide all forms, and the greater desire for self-reliance on both water and electricity, and of course the other things, but that's outside this discussion. We don't need to go full prepper, is going to see massive demand for silver. I was listening to someone speak today, and they were saying, well, oil's been so unloved and all of these other things, searching for it. Mining itself as part of the ESG principle has been unloved. So very few pure play silver plays. And I can see this is coming up to a very exciting period. I'm about as bullish as I've been, particularly gold to start. By the way, on the analogy of the gold, I would really like to give this to everybody. It's somewhat silly, but it's kind of like the truck. The 4x4 climbing the mountain is gold. It has the engine it leads, but instead of a tow rope, you've used a really fat bungee cord, and it extends, and you've got a trailer with weight with your silver bars in it, and you're climbing the hill. What actually happens is the truck is making progress, but a lot of the force has been taken up in the tension of the cord, and the silver is lagging. And we've certainly done that. Remember, it's 8 ounces found of silver for every ounce of gold generally. And we've just continued to stretch. And when you think you can't stretch anymore, there's a little bit of flexion, just in the connection between the 4x4 and the trailer. There's a final little creak. And then suddenly that kinetic energy has built up so much that potential energy turns into kinetic energy and shoots the trailer after the truck. And that's why I consider it a sort of truck and trailer environment with the bungee cord with silver. And that's why it will be so exciting. I think silver is an absolute screaming buy, and I think gold is a tradable setup with moderate leverage for those that have the experience.
Silver acts as a lagging indicator for gold, often offering more volatility than gold, which is generally considered a more stable alternative. However, during bull markets, silver doesn't just outperform gold. It goes on a massive explosive run for a short period of time. Do you think silver is trying to make similar moves? Will we get a reversion of the gold-silver ratio to its historical levels? Please drop your comments and observations in the comments section below. Also, ensure you hit the like button, subscribe to the channel, and turn on the notifications for more videos on silver, gold, and copper. Thanks for watching.